Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our Head of Research, Jasper Lawler, to discuss the importance of 7300 for the FTSE, the Federal Reserve starting to unwind quantitative easing in October, whether the rebound in the dollar has further to go, and gold falling back below 1300. But first, the biggest earnings releases and economic calendar items this week. Starting with corporate results, Carnival and Air Berlin will release earnings on Monday. On Tuesday, it's AG Bar, AA, Card Factory and Nike. Boohoo.com and DX Group on Wednesday, Moss Brothers and Rite Aid on Thursday, and finishing up with Carillion on Friday. Moving on to the economic calendar, we've picked out what we think could be the most market-moving releases. On Monday, we have German IFO and the Bank of Japan meeting minutes. On Tuesday, UK inflation report hearings. On Wednesday, UK second quarter GDP, US durable goods orders, and Reserve Bank of New Zealand's policy decision. On Thursday, it's German inflation, US second quarter GDP, and Japanese inflation. And on Friday, it's European inflation and personal spending in the US. So Jasper, the FTSE nosedived after the Bank of England signalled a rate hike. Then last week we got a bounce. What's your view on this?
Well, Kelly, I think there's two factors to consider here. One is that the pound is going up, so naturally the FTSE tends to go down when that happens. But on the flip side, other indices around the world, other benchmarks around the world are going up. So we last week in the US, we saw 5 straight record high closes for the S&P 500. The DAX looks like it's broken out of its correction. So there's a general drag higher, a general risk-on mood in markets. So I think that's sort of limiting the decline somewhat in the FTSE and probably why we saw that bounce last week. Two possible reasons that 7,300 holds in the FTSE. Just the pound starts rallying again. That looks slightly less likely after the Fed meeting, or sentiment in markets sours a bit. And I think that is quite possible because we're looking pretty overstretched in the US. And we did have the Fed announcing that QT, quantitative tightening. So I think maybe we have a last gasp and then maybe there's room for a correction. And probably if we do get a little pullback in markets, that's when I imagine the weakness in the FTSE would probably outstrip those other benchmarks.
And we said in our last video that the biggest event of the week was the Fed, and they did announce some big news. But has markets' reaction been a little bit muted, would you say?
Yeah, I would say muted in the stock market. And this is something that IPEC and I were talking about in our preview webinar of the FOMC meeting, is that you can basically spin a positive reaction in stocks either way, because it's, the Fed is more dovish. That means lower rates for longer. The Fed is more hawkish. That means better economic growth for the US, both of which can be spun as good for the US market, for US stocks. And so that's pretty much what we saw. I think probably the more interesting implications here are for the dollar. And so just to sort of quickly say without going into too much detail, they're no longer going to be reinvesting their bonds. So the result of that is this sort of roughly $4.5 trillion balance sheet they have they had been reinvesting the proceeds of those bonds in order to keep the balance sheet the same size. Now they won't be doing that. So it's going to gradually be tapering off. But I think that's another reason why there was no dramatic reaction in markets. A, it was really well telegraphed. And B, so they're starting off with 10 billion in terms of tapering that size of the balance sheet. 10 billion sounds like a lot, but in the context of 4.5 trillion, it's small potatoes. So it's not really a big deal at the moment.
Yeah. And so is this a change in attitude in the dollar, would you say?
Potentially, yeah. I mean, I think when you look at some of the levels that we're at in the dollar, so for example, 120 in the euro, 0.80 in Aussie dollar, 110 in dollar yen, there's some quite significant price levels where you'd naturally expect the market to kind of have a little temporary, at least, shift anyway. And so I think probably whether the rebound continues depends probably on how much the Fed kind of backs this up in terms of Fed speakers over the coming weeks. Generally, I think monetary policy between the central banks is getting closer. And so given the backdrop of this is actually a big rally in the dollar, I think overall the dollar's still got more room to weaken. But in the interim, you can kind of see how maybe the ECB take their time with moving towards tapering their QE program, and the Fed, basically getting on with it. So you can see how the dollar could actually strengthen maybe in the interim from these levels.
Yeah, and obviously related to the dollar, I guess, gold dropped back through 1,300 too.
Yeah, I mean, was pretty much dollar went up, gold went down. We've been talking about the risk of this happening because, what was driving gold? Well, it was weakness in the dollar and it was geopolitical tensions. Well, North Korea kind of faded into the background for now. Those geopolitical tensions subsiding. Even if we talk about the German election, looks like it's going to be a fairly predictable result. So you don't have that geopolitical tension. Now you've got the dollar potentially reversing here as well. So both negatives for gold. Still, as I look at it, gold went up this year more than the dollar went down. So I think there's an inherent demand for gold, and it's going to find support at some point, but it's been a really choppy uptrend this year. So we're around the 50-day moving average in gold at the moment. I wouldn't be surprised to see it go further below that.
Mm-hmm. Thank you so much, Jasper. So at the time of filming this, we do not know the German election results, so please check out our feature video on what the German election means for markets, as well as any updates on our website. Thank you for watching, and if you want to see these videos as soon as they're released, please follow us on social media.